In June 2026, a leak from the most prominent generative AI lab revealed an operating reality that defied conventional logic. Against $13 billion in revenue, the company recorded a $38.5 billion net loss. These numbers immediately rattled financial markets. Investors and institutional lenders began heavily scrutinizing tech portfolios, asking if the capital flowing into artificial intelligence was setting up the entire sector for a systemic collapse. The tension here stems from a unique contradiction. We are looking at a product with hundreds of millions of active users and billions in real consumer spending, yet the cost to operate the technology vastly exceeds the income it generates. To evaluate the actual economic viability of this technology, we have to look past the top-line valuations. We need to dismantle the artificial intelligence ecosystem and examine how capital moves through its three distinct layers. At the base is the hardware layer, where massive capital builds physical data centers. Sitting on top are foundation models, highly funded labs training the core AI brains. Finally, the application layer encompasses the consumer tools built using the models below. The extreme capital requirements at the bottom create intense financial pressure, but that same pressure generates a uniquely advantageous environment for the agile businesses operating safely at the top of the stack. Scaling artificial intelligence requires a very specific physical footprint. Companies are engaged in a fierce procurement race to acquire specialized semiconductors and the vast electrical infrastructure required to keep them running. The labs building foundation models need these exact resources to train their algorithms. To secure them, they have adopted an economic structure known as vendor financing. Major tech conglomerates invest billions into AI labs, who hand that capital right back to pay for cloud servers. This cycle reveals negative unit economics. Labs spend up to $2 on raw processing for every single dollar of revenue. The resulting multi-billion-dollar revenue figures look impressive on a balance sheet, but the cash is largely flowing in a closed loop, subsidized heavily by tech monopolies to keep the servers running. We have seen this specific capital structure before. During the late 1990s, early telecom startups frequently bought expensive networking equipment using money loaned to them directly by the hardware manufacturers. Many of those companies lost money on every transaction, operating on the theory that if they captured enough users, massive scale would eventually bend the curve toward profitability. The result was a frantic, debt-fueled rush to lay thousands of miles of fiber optic cables across the country, mirroring today's massive expenditure on data centers and server clusters. When the capital eventually dried up, those highly leveraged businesses collapsed. But the underlying technology survived. A market correction wipes out unsustainable capital plans. It does not erase the infrastructure itself. If macro funding conditions tighten, the cycle breaks. Hyperscalers are forced to slash their server budgets, and the foundation models that depend on them miss their targets and fail to raise new rounds of funding. But the massive physical footprints, the cooling systems, the power lines, and the server racks stay exactly where they are. This creates an economic glut. An immense oversupply of installed processing hardware floods the market, which forces the cost of running and querying an AI model to drop precipitously. The financial failure of the massive central operators becomes a structural subsidy for everyone else. Stripped of the exorbitant hardware debt, building practical software suddenly becomes highly profitable. For founders and developers positioned at the application layer, this impending environment offers a profound structural advantage. The first operational rule is to treat foundation models as a depreciating commodity. The intelligence itself is an input cost that will consistently fall as hardware efficiencies improve. The second rule is architectural flexibility. Systems must be built so that if a major vendor goes bankrupt, the underlying model can be swapped out immediately without disrupting the core business. Finally, developers must target specific high-margin functions. Tasks like emerging market credit scoring, risk evaluation, and compliance monitoring require deep domain expertise, but they require very little raw computing power to execute. These specialized tools capture real revenue because they solve direct corporate problems, and crucially, they do so without carrying the multi-billion-dollar server leases required to build the underlying models. Looking closely at the aftermath of the early internet reveals a clear pattern. the companies that emerged to dominate e-commerce did so by utilizing the cheap, abandoned bandwidth laid by the businesses that failed before them. The defining entities of the following decade operated entirely at the application layer. They focused on search, indexing, and digital communication, completely bypassing the crushing capital debt of the initial telecommunications boom. The infrastructure required to power artificial intelligence will inevitably face a severe financial repricing, but the practical utility of the technology will persist long after the speculative capital evaporates. As the market clears out the over-leveraged monopolies, a sustainable ecosystem takes shape in their place. For anyone looking to generate actual returns in this landscape, the strategy is clear. The economic reward does not go to the people spending billions to build the engine. It goes to the people who know how to drive the car.